On behalf of our team at HBKS Wealth Advisors, I would like to welcome you to What's Coming, the Economic Outlook for the Remainder of 2021 with HBKS Principal and Chief Investment Officer Brian Sommers and HBKS Principal and Senior Financial Advisor Matt Costigan. Our session today is scheduled for 60 minutes and is being recorded. Please note that all attendees are set up in listen-only mode. If you would like to submit a question to our panel, please use the question box in the GoToWebinar control bar. We value your feedback. Please complete the survey at the end of the session to let us know how we did. If you would like a complimentary financial review, please let us know via the survey or by email. For more information and insights, please visit hbkswealth.com/insights. This time, I'd like to turn it over to Matt Costigan.
Welcome, everyone. Thanks so much for joining us here today. Brian, economic growth seemed to be slowing again at the beginning of this year, but is really gaining steam recently. What happened in such a short time to allow the economy to recover faster than many economists expected?
So thank you, Matt, and good afternoon, everyone. So there's no doubt that economic activity is now strengthening after a rough start to the year. At the beginning of the year, the COVID numbers were spiking after the holidays, and the vaccine rollout got off to a really rough start. Also, it appeared that the Senate was going to be divided, and we were not going to get the additional stimulus passed. But by the end of the quarter, the economy was recovering faster than most economists expected. And there are a couple reasons for the improvements. First, the distribution of vaccines is going much more smoothly than it was early in the year. And many people now believe that we're going to gain herd immunity by the end of May. If you look at the chart that we have here, you can see how since the beginning of the year, the number of people who have been infected with COVID has been dropping rapidly. There was a little bit of an increase in March, which was a little bit concerning, but since then that has rolled back over. And now in most parts of the country, it's declining fairly steadily. There are a few hotspots in the country, and there's also a few hotspots around the world, India being one of them, where cases are still rising. But for the most part, it's declining fairly rapidly. Also in the United States, we're vaccinating right now at about 4% of the population per week. And so at the current rate, we should reach herd immunity by the middle of May. The chart on the right shows the number of people in blue who have been infected. And then on top of that, the number of people who have been vaccinated. And you can see that we are by now close to 60%. And that range for herd immunity is between 60 and 80%. So in the United States, we should be there sometime in May. And so while the vaccinations haven't completely eliminated the risk of contracting COVID-19, they do appear to have dramatically reduced the risk that people are going to die or need to be hospitalized if they do contract it. Another factor in the economy rebounding is that the historic stimulus bill is on target to be passed, and many people are flush with cash thanks to their stimulus checks. The Biden administration is also proposing additional spending on infrastructure. So there's the anticipation of more money floating around in the economy at this point.
Oh, it's all good to hear. So people they're really starting to are now feeling safer about going out for their entertainment, it seems like.
And that's right. Data that can be collected almost immediately after transactions take place, or high frequency data, has started to rebound much more quickly. Airport traffic, restaurant dining, and hotel occupancy all are up pretty dramatically. The chart that we're showing here is The Economist magazine uses data from Google to track the high frequency data. And you can see there was a pretty big decline at the beginning of the pandemic and the lockdown and activity. And then it rebounded fairly quickly from the depths of the lockdown, but then it kind of stalled. And for the vast majority of the past year, it had either been flat or even towards the end of last year and the beginning of this year was trending back down again. But now you can see as people have become more confident to go out and it has spiked up again. So now we're only about 20% below where we were at the beginning of the pandemic. So people are definitely getting out and about and driving economic growth faster than was expected just a few months ago.
All right, Brian. Well, it's been it's certainly been a really nice ride upwards from where we were, and this is a question that I get constantly from our clients. How long do you think the recovery is going to last?
Well, there's a rule of thumb in economics that the size of the rebound in growth after a contraction is about equivalent to the size of the contraction. And so what we have here is a chart which shows some of the prior contractions and their subsequent rebounds, with the contraction charted on the x-axis and the rebound charted on the y. And you can see that there is a positive, about a one-to-one positive relationship between the size of the contraction and the size of the expansion after that contraction. And so you can see in the upper right-hand corner is where we are today. And so if this relationship holds true, it could be possible that we have already had the majority of the rebound in activity already. Now, it is true that this rebound is going to be turbocharged by all of the fiscal and monetary stimulus. So it's probable that the rebound is going to be a bit higher than it normally would have been, but it remains to be seen how much that stimulus is going to push it beyond that and how much longer it goes.
That's really good to see. So just to clarify, does that mean you believe investors have become too optimistic in their view of how strong the recovery will be?
I do think that it's possible that people are now too optimistic. In the span of just a few months, both consumers and economic forecasters have gone from extreme pessimism to extreme optimism. The chart that we're showing here shows that it's the JP Morgan Forecast Revision Index, and it shows the extent that economists are revising their forecast either up or down. And so you can see at the start of the pandemic, there was a dramatic reduction in forecast as the economy got locked down. And then as we went through last year, economists were revising their forecast higher and higher and higher. But it wasn't until March when we got its biggest upward move in history, where economists became extremely optimistic and revised their forecast for growth for the rest of this year dramatically higher. Also, consumer confidence, and the consumer confidence indicator posted its biggest one-month gain since 2003. And this change in sentiment does make a lot of sense, because if you think back, in January, the economic data was weak because there were fears that the recovery would be delayed due to another round of infections after the holidays. Also, people were worried that the stimulus might not pass through Congress. So there was a lot of concern. But then by March, those fears were gone as growth accelerated. And as we said before, people are getting out and about and moving around and driving economic growth. But now there are completely different concerns. Some are worried that the economy will become overheated and cause runaway inflation.
Okay, and so that makes sense. Are you concerned about the economy growing too rapidly at this point?
While that's certainly a possibility, I think the probability is low that the economy is going to get overheated and cause runaway inflation. After the initial surge in growth, as business activity in the United States is restarted in the next eight or 9 months or so, the economy is probably going to revert to the slow growth we saw before the pandemic. And I say that because the impact of the fiscal stimulus might have less of a long-term effect on growth than a lot of people are expecting. Last year during the lockdowns, many consumers cut back on travel and entertainment, but boosted their spending on household goods. The chart that we're showing here shows that. You can see that there was a dramatic downturn in spending on big ticket items as the pandemic started, but then right away, even during the lockdowns, there was a dramatic recovery. So purchases of homes and cars and other big ticket items for people's homes jumped dramatically higher than it had been even before the pandemic. And what possibly could be happening is that because people weren't going out and spending their money on entertainment, they were staying home and spending their money on these big ticket items. And it's very possible that we have pulled growth from the future into last year. And so what could be happening then as the economy opens up is that as people continue to get out and about, the higher spending on travel and entertainment could be offset by a drop in the spending on these durable goods. And if that happens, which I think is pretty likely, this is going to hurt GDP growth because spending on leisure activities does not get multiplied as fast through the economy as spending on durable goods, because spending on durable goods has a very long supply chain, and it has a bigger impact on the growth numbers as the transactions flow down through that entire supply chain. The entertainment industry and the restaurant industry and hotel has a much shorter supply chain, and so it has a much shorter multiplier through the economy. So as a result, the burst in economic activity that we get this year is probably going to be followed by a long, slow recovery, similar to what we had before the pandemic. And the inflationary pressures are going to ease. Economic growth may be solid, but potentially on a lower trajectory than many anticipate. Another thing to mention is that one of the things that was driving this increase in purchase of big items is that last year income levels actually rose almost 5% despite the shutdown of economic activity. There were a lot of industries that were doing fairly well, and then the people that lost their jobs, there were a lot of those people, their stimulus checks were actually more than they were making whenever they were working. And so that undoubtedly boosted spending. But remember, the stimulus checks are going to eventually stop. And the extra unemployment benefits are also going to end in the fall. And so if employment doesn't rise, remember, we still have much higher unemployment now than we did before the pandemic. And so if employment levels don't get back up to pre-pandemic levels, then it's possible that consumer spending may actually fall. And then the last thing that I would mention is that a lot of the government stimulus, a lot of people keep talking about, well, but there's all this money floating out in the economy and the government stimulus is going to keep the economy going. But it's also important to note that a lot of that stimulus is going to provide rescue funds and to prevent growth from collapsing, not necessarily to stimulate new investment, because a lot of the stimulus is going to state and local governments and universities to plug deficits. It's also going to vaccine distribution. So that's not conducive to spending and increasing growth. It's basically just plugging gaps. And then finally, although the Federal Reserve is likely not to raise rates until probably 2023, they may begin tapering their bond purchases or cutting back on those bond purchases. And this would begin to remove some of that liquidity that's in the market that's out there right now, which would be another reason that growth could slow. So that's a lot of reasons why I think that that the stimulus is only going to provide a short-term boost to economic growth and won't have a lasting effect that would cause inflation to rise.
Okay, yeah, very, very, very helpful. So to clarify, you don't believe that the huge amount of government spending, and it is huge by anyone's measure, will cause inflation to really soar?
I don't think that inflation is going to be a problem for the next several years anyway. Inflation did rise 4.2% in March, which was the fastest pace since 2011. And I'm sure everyone on the call will recognize that many commodities have shot up, the price of homes, the price of cars. There has been a lot of inflationary pressures in the system. However, if we look at the longer term chart of inflation, you can see that we still remain in a downward trend. And the spike that we saw in inflation back in 2011 proved to be transient back then, and it may this time as well. You can see the spike higher towards the end of this chart still is fairly low historically speaking. And I agree with Federal Chairman Jerome Powell, who believes that the rise in inflation that we're seeing over the last couple months will be transitory. The inflationary pressures that we're seeing are being caused by an imbalance between the demand for products and the supply. So what happened was the demand has been pushed higher because of all the stimulus and the checks that people have been getting and the income rise that we've seen. It's been pushing demand higher, but suppliers don't want to commit to increasing expansion of their production because they don't believe that demand will last. And so this is creating an inadequate supply of goods, causing the prices to spike higher. But if the demand subsides eventually, then the inflationary pressures will ease also. So, once the economy is fully open, the economic forces that have been in place for many years, that have been keeping inflation low, global competition, improvements in technology, just-in-time inventory management, they're all still in place. Remember that the Federal Reserve has been trying unsuccessfully for many years to generate inflation. And inflation has gone nowhere. Also, the US economy is nowhere near full employment. And if you look back historically, inflation has we've never had runaway inflation or a large sustained spike in inflation with unemployment levels where they are currently. So longer term, I do think that inflation may become an issue. You know, all of this spending eventually could cause inflation. But I'm of the camp that believes that all of that spending was necessary to avoid a total collapse of our economy. And longer term, we have to have the confidence that the global leaders of the central banks have the tools and the knowledge necessary to be able to battle inflation when it does occur, if it occurs down the road. You know, and it may not even cause inflation at all. You know, like I said, they've been trying to generate inflation for some time, unsuccessfully, and too much government debt can be deflationary, because a larger portion of any rise in income has to go to pay off the debt instead of spending it.
Okay, deflationary, that's interesting. So that's been the situation in Japan for a long time now, right?
Exactly. So let's look at Japan as an example. Japan has spent billions over the last several decades. We have here a chart of their government debt as a share of total GDP, and you can see their total government debt as a share of total GDP in Japan was hovering around 40% back in the 90s. And then in order to spur inflation, they began spending. And their total government debt rose gradually over the next several decades till it was over 200% of total GDP. And it stayed at that 200% level for some time until the pandemic, where you can see it spiked again up to about 230% of total GDP. And despite all of this spending, inflation in Japan has remained rather subdued because of these deflationary forces that I mentioned. On the right-hand side, you can see a chart of the inflation in Japan. And you can see it has remained very modest, although there has been several spikes higher over the last 30 years. Each of those spikes proved to be short-term, and it fell back to very modest inflation. So in addition to all of those forces that I mentioned before, those global forces that are keeping inflation low, Japan has also been dealing with the huge debt that they've run up over the last 30 years, an aging population, and high personal savings. And the result has been that their economy has had decent but low growth, low unemployment, and social stability. But the offset to that has been low growth and very low inflation. And so it's very possible that with all of the spending that has been going on around the world over the last year, it's possible that the United States and the rest of the world may go down the same path as Japan has over the next decade because of the massive debts that governments now hold.
Well, that would certainly be a interesting scenario to see. And so my job, you know, as an advisor is to, you know, we work with clients on, you know, what are their longer term financial planning projection. But, you know, based upon everything that you've laid out, what do you think this means for capital market returns over this next year?
Well, so as we talked a little bit earlier about the very optimistic view of the economy going forward. And so it's very possible that this extremely optimistic outlook has already been priced into both bond and stock prices. You know, the positive and optimistic economic scenario that people are expecting are being reflected in what analysts are projecting for corporate earnings. And so if growth is expected, or if it's less than expected, which is what we think is highly probable, then we could see some more volatility in the markets later this year, and returns in the stock market could be less than expected, while the outlook for bonds may be a bit brighter than expected if a more pessimistic view comes to fruition. So, if we look at valuations on the left-hand side in the stock market, as the market has run up over the last several years, the PE has also risen. And so while the price to earnings ratio, which is a good measure of how expensive the market is, it is stretched at this point. It's a bit higher than average, but it's not, in my opinion, it's not at bubble levels. It's not near where it was, back in the late 90s, early 2000s, but it is stretched. And so, but if you look deeper underneath, you'll see that there are a couple of sectors that have been driving that, where I do believe that there might be a bubble, but there are also some opportunities. One of the other things, in addition to some of the valuations being expensive, the recent proposal that would double the capital gains tax also will be an additional headwind for stocks. In the short term, it might cause a pause in the rally, and over the longer term, it might cause stocks to be a bit less attractive, which could lower their longer term performance. But even all of that said, I do think that overall stocks are likely to trend higher the rest of this year, but the returns are going to be choppier. And also the stocks that lead the market forward are likely to be different than those that led the way in the bull market. The stocks that led their way in the bull market have been the large, high growth names in the technology and consumer discretionary sector. And that makes sense, because stocks in these sectors actually did very well during the lockdown, because they were leaders in several trends that shaped the economy at that point. Things like working from home and Zoom calls and shopping from home, and all of these things that people have been doing are supported by a lot of these large technology companies. Cloud computing is another one of them. However, it's quite possible that a lot of the growth for these stocks have been pulled into the present. And so now these stocks are priced for perfection. And we believe that there's a number of reasons why stocks in these sectors could slow. In addition to the growth being pulled into the last year, also regulators are taking a look at what restrictions should be placed on these companies because of privacy and monopoly concerns. Tax policies in not just the United States, but many other countries as well, are being reviewed to make sure that these companies are paying what is considered to be their fair share of their outsized profits. So there's a lot of questions as to whether these companies will continue to grow as fast as they did during the pandemic. And as I said, they are priced for perfection, in my opinion. So I think that there could be some change in leadership between those companies and the companies that you can see on the right-hand side of that chart that are much less expensive and happen to benefit from the economy reopening. Sectors like energy and utilities and financials and industrials. The prices in these sectors are going to benefit from the increase in economic growth as the economy opens. And as I said, their valuations are much less expensive. So it's likely that we're going to see the shift from those large mega cap growth companies into these more economically sensitive type companies. And anytime we get that market shift, typically markets are also choppier than they typically are. So we're also likely to see a little bit more volatility in the markets. The other area that I think is going to do well in the market, a lot of these trends that I mentioned are not going away. They're going to continue to be trends. But as I mentioned, the mega cap companies that are benefiting from these trends are priced to perfection. But again, if you look underneath the surface, there are a lot of smaller companies that provide the resources that allows these trends to occur. They're also benefiting, but they're a little bit smaller and under the radar, so their valuations are a bit less expensive. So I think those companies are likely to do well also, in addition to the sectors that I mentioned.
Well, I really like how you phrase that, price for perfection. And, certainly, what we use at HBKS as a core diversifier is fixed income. So what about the bond market?
Yeah, so with rates rising recently, expectations for returns in the bond market are very low, because just as a lot of people have a very optimistic view of the economy, that would translate into people thinking that rates are going to continue to rise, which would mean very little to no return in the bond market. However, if the scenario that we believe plays out, where growth actually is a bit more disappointing than what some people anticipate, then it's highly likely that the inflationary pressures will ease, and the pressures for rates to keep rising will also come back down. So, we believe that rates, while they might rise a little bit higher, are going to be stuck in the current range where we are in right now, where they are a bit higher than the range that we were trading in for a while, but they're not going to trend much higher from current levels. And so a lot of people also don't believe that whenever the Fed says they're not going to hike rates until 2023, a lot of people think that, well, if these inflationary pressures continue, they're going to be forced to raise sooner than that in 2022. But if, once again, growth is more moderate than expected, then the Fed can stay true to their word and not hike rates until 2023. All of that would translate into bonds holding up better than people suspect. And the sell-off that we have seen in bonds might be overdone. And so longer term, over the next several years, bonds might perform a bit better than most people anticipate. That doesn't mean that we're going to get high single-digit or even double-digit returns in the bond market, but it does mean that they're likely to maintain their status as being volatility reducers, solid hedges against a downturn in the stock market, and at least maintain their current income level, not deteriorate. And also, with no recession in sight, we do think that the strong relative performance in high yield or lower credit bonds also should continue. So we also recommend an allocation to high yield as well.
So that's good. Yeah, important to have that type of exposure. So, okay, so to summarize, it sounds like returns in both equity and fixed income markets should be modest but positive in 2021. And there's still several pockets of opportunity still out there. However, probably more bouts of volatility coming as investors realize economic growth will not be as long as probably they currently anticipate. So from what I tell my clients, and I'll add, we believe at HBKS about using a balanced approach, which incorporates broad diversity amongst some asset classes that will benefit from the recovery and economic growth, as well as some asset classes that will protect a portfolio from losses during stressful times. It's certainly well suited for this environment. So thanks, Brian, for reviewing all that. Started to get some questions that come in from everyone out there participating in the webinar. So certainly appreciate everyone participating. So we're going to start to review. This is, I'm taking a look at this one right here. It's got that we pulled off, and it's one that I get from some of my clients that are looking to move or expand what they're currently doing at home. So construction materials have experienced significant price increases in 2021. How is this factored into inflation numbers? Do you see a reduction in material costs in 2021? Will there be any relief?
Yeah, that's a great question. The housing industry is something that has, there's very long lead times, and so inflation tends to persist a bit longer in that industry. And as the person who posed that question notes, we have seen a lot of prices spike higher in a lot of the materials that go into building a house. And so that is probably going to continue, at least for the foreseeable future. The housing industry has been on fire in a lot of the neighborhoods that I look at and that I live in. Houses don't stay on the market beyond a couple days. They'll go on the market, and before you can even call that you're interested, it's already sold for a lot of times higher than the asking price. So, as long as the housing industry stays so strong, I think that's one area where inflation is likely to persist for a little bit longer. But once we get out into 2022, I think that the slowdown in economic growth, just like everywhere else in the economy, it's also going to ease some of those inflationary pressures, and prices should begin to settle back down, as we get into 2022.
Yeah, you really hear some of those. Everyone's got those, crazy stories, whether they're going through the moving process, going through some sort of home renovation or construction, where they really start to see these huge price increases, and what is that going to look like? Yeah, it'll be really interesting to see where we end up, and how that's going to look. I wanted to follow up on. Yeah, go ahead.
I was going to say, the other factor is, as I mentioned before, people are now getting out and about, and whenever they were during the pandemic, they were spending a lot of money on home improvements, and that was driving a lot of these materials prices higher as well. And so whenever people again get out of the home, they're likely to stop or at least slow their pace of house improvements, which again is going to alleviate some of those price pressures as well.
You mean to tell me that people are actually going to leave their homes again at some point and go out and spend money in other places? No, it really, I mean, I think that's, it's great to be able to see that, we're going to see spending in some of these other areas, as opposed to, you laid out, these large tech conglomerates, really, going in and, having a big advantage and seeing this just exponential growth, and that, we're going to see really some, possible regulatory requirements, whether it's, a tax based upon, book income for, these companies, or, possibly getting broken up for a monopoly as well. So it'll be really interesting to see how this plays out as vaccine starts to ramp up, and we continue to see folks really go out there and start to spend some of their money outside of just going online. So
yeah,
let me go.
Well, I was going to say there's a lot of industries that really have been hanging on by a thread, and for the restaurant industry, the theater industry, the end of the lockdown can't come fast enough. Those people need to get back to work and begin making a living again. I feel for them.
So when we talk about, what are some of these, higher shift, or some of these, equities, different types of equities, do you see a shift coming from, maybe value versus growth at some point?
Yeah, the big value versus growth debate, which is people have been anticipating that switch from value to growth for a very long time. And every time we get somewhat of a switch, it goes right back to the leadership of growth. If you look at what the market action has been over the last year, every time the news has been good regarding economic growth, recovery, people getting back to work, the value stocks did better than growth. But then every time there was a period where either the people were becoming infected, the infections were rising, or for one reason or another, the growth data was disappointing, and that's whenever the growth stocks outperform the value. And it makes sense because, whenever the economy is not growing, people look for growth wherever they can find it. And during the pandemic, that growth was in some of these high growth sectors. I do believe that once the economy is opened up and we do get a more sustainable recovery, that reversal out of the growth and into the value, a lot of those sectors that I mentioned that benefit from the recovery and growth, the financials, the energy, the utilities, they're your traditional value sectors. And so, even though we think of it in that value versus growth, I think it's really, you can think of it as, recovery stocks versus lockdown stocks. And as the economy reopens, the recovery stocks are likely to do better, which just happen to be more value. Longer term though, after we get beyond, say, the next year and the economy's open again, I think that we're likely to be in an environment where neither growth nor value leads, but the entire market then advances, and the returns will be more broad-based across the whole economy.
Yeah, and I completely, see that happening. Growth has certainly been a leader for quite some time. But let's talk about and get your perspective on, non-US. Do you see emerging markets as an opportunity investment right now?
I do, yeah. I mean, I think that, foreign stocks in general have much lower valuations than stocks in the US, but that's been the case for some time. But I think in the emerging markets in particular, there is a lot of growth that's happening there. As the supply chains for a lot of the companies get reworked, a lot of people with the situation and the disappointment and some of the feelings towards China, people are pulling a lot of their supply chains out of China, but that's good for a lot of the other Asian emerging economies because there's a lot of that is flowing to those countries. And so, I think that the future is bright for a lot of those, particularly Asian emerging markets, especially once we get beyond this pandemic. The other thing is that with all of the spending that we've done here in the U.S., it's highly likely that the dollar, the U.S. dollar, is likely to get a bit weaker. And if the dollar weakens, that is also a positive scenario for the emerging markets. So I think the combination of stronger growth, cheaper valuations, and a weaker dollar are likely to make the emerging markets be a pretty good market to be in.
Yeah, interesting. So that should definitely be, considered part of someone's portfolio that's looking for higher growth over the long term. Then that sounds like that it would be pretty necessary to be able to have.
Definitely.
Great. I'm gonna remind everyone that that the replay of this webinar will be available online on our website. Is a link to our YouTube page if you want to rewatch, revisit any points that Brian has gone over. Certainly share it with anyone you think that would benefit from this information, and then would remind everyone of everything that we have on our website. It's an overview of all services that HBKS provides. It's going to give you an insight on some different advisors, articles that we've written, from everything from personal financial planning topics to market commentary. And if you're interested in more information about HBKS, if you're currently not working with us, please go online and see client service team that services your geographic area, and we certainly encourage everyone to sign up for future webinars and resources like this. And I'll remind everyone as well, there will be a survey given at the end of this webinar. Will automatically pop up. So please participate in that. We really appreciate it. So thanks everyone for your attention and joining us today. Really appreciate it. Have a great day, and we'll talk to you all soon.
Thanks everyone.